About a month ago, I asked my community what they were most interested in when they were investing. Was it the fees that they were having to pay, or was it the ease of investing? And I found out that 2/3 of respondents were more concerned with the ease of investing rather than fees. I've talked a lot on this channel about my 6-fund portfolio and how it reduces my fees from 0.22% right down to 0.11%. But if people are more interested in ease, where can they invest on Vanguard? Look no further than the VWRL, or Vanguard's All-World ETF. While I don't hold the specific ETF within my portfolio, for people who are new to investing, who want one fund to invest in every single month, this is probably one of the easiest ways that you can do it. Yes, you could invest in an index fund that's an accumulation variant of a fund, so you wouldn't then have to reinvest your dividends. But if you're new to investing and want to get used to having dividends come in every single quarter and like the idea of reinvesting those dividends, the VWRL is the best fund for you to invest in. So if you find the FTSE All-World ETF on Vanguard, as you can see here, you can see it shows you a nice breakdown of the fund in total. It gives you the market price, the number of stocks within that portfolio or within that ETF, the ongoing charge, and the risk rating, which is out of 7 on Vanguard. You can see that the current market price is £86.65, and this includes 3,781 individual companies. So in terms of diversification, it is very, very good. Not quite in the same ballpark as the LifeStrategy, which does hold around 23,000 stocks, but for a globally diversified fund, this is truly excellent. The ongoing charge fee is 0.22%, which is exactly the same as the Vanguard LifeStrategy suite of funds. So there's a bit of parity there between the two. The risk is rated at 5 out of 7, and this is because this fund is 100% equities. There's no bonds or cash included here. Any money you invest into this ETF is put entirely into the stock market. If we scroll down a little bit more, we can see the total assets invested in this ETF are 7.9 billion. So there's a lot of people investing in this product. And you can see a breakdown of the performance over the last 5 years currently. So you can see we've had 4 positive years. Of course, last year was an exceptional year with the fund up 33%. However, this year it is down around 10.5%. And something that is worth noting is that both the net asset value, the NAV, and the benchmark, so the actual global stock market itself, are very, very close to one another. And this suggests that the ETF very closely matches the return of the all-world stock market, which is what we'd expect it to do, being an ETF of just that. If we scroll down even further, we can have a look at how £10,000 invested would have progressed over the last 10 years. So whilst it says dollars on here, it is essentially the same thing. You can see that for £10,000 invested in May of 2012 would now be worth £26,000. So that's a return of 160% in around 10 years, which you can't grumble with. If we hop into the price and performance, you can see that the market value of this ETF is currently £86.65, as we already suggested. However, the 52-week high was £93 and a penny, and the 52-week low was £78. You can see there's been quite a lot of volatility within the market, which, if you've been investing over the last 6 months, you will know only too well. From this screen, you can search more historical prices, so you can see a value of the ETF at the end of every single day. So at each market close, this information here will update. So you can see yesterday obviously closed at £86.65. The day before it was at 87.26. So you can track the movement of this fund over time just to see whereabouts it's sat. You can also have a look at the price analysis. So this is over the last week, but if we click to the last 18 months, you can see that we climbed throughout 2021, much like the all-world stock market. Got to kind of November sort of time, and we've been on a steady decline since then. We have seen a bit of a market rally since kind of the middle of July. And that is steadily moving forwards at the moment. Like I say, we don't know what's going to happen with a potential recession coming, but it's been good to see it turn a corner and start to increase in value again. Something that is worth noting in the portfolio data is the number of stocks that are included. Obviously in the VWRL, so the ETF itself, there are 3,781 stocks included. However, in the benchmark, so the actual FTSE All-World Index, there are actually 4,114 stocks. So there is a bit of disparity there between what the actual stock market includes and what the VWRL holds to mirror that stock market. In essence, the ETF holds 333 less stocks than the actual index itself. However, as we've seen, the ETF does track very closely to the return of the stock market. So we're not too concerned about that there. This is probably because of the cost it would incur to include smaller stocks within this ETF. And that would of course raise the OCF, or the ongoing charges fee. Of course, with the Russia-Ukraine conflict, lots of stocks have been frozen which are held within Russia. So that again may be another reason for that disparity. But as we've said, because it still tracks very closely the return of the all-world stock market, we're not too concerned about that. If we pull us down even further, you can see the region exposure. You can see this ETF is heavily exposed to North America, so the United States and Canada, with around 62% of the allocation going towards those geographical regions. Around 16% is allocated towards Europe, around 11% to Pacific, so that would include stocks in New Zealand, Australia, Indonesia, Singapore. The emerging markets around 11%, so you've got China, Taiwan, Brazil and some South American countries in there. The Middle East, 0.2%, and then other 0.1%. So those are the allocations within this portfolio. If you pull down even further, you can see how that's distinguished between different countries. So America is actually around 59% of this entire ETF, and that's to be expected because of things like Facebook, Amazon, Tesla, Apple, Microsoft, the list goes on. We've then got Japan, China, United Kingdom on around 4.1% here, and you can scroll slowly down and see all the rest of the allocations towards the different countries here. And this is based off of the market capitalization of each of those individual stock markets. So it's not just numbers that are pulled out of thin air, it is diversified based on market capitalization. If you go right down to the bottom, you can see further though diversification across different industries and sectors. So you can see technology is the largest allocation towards this ETF at just over 21%. And we've of course got financials, consumer discretionary, healthcare, all the way down to a little bit of real estate, which is included just down here at the bottom, which is likely things like realty income and other REITs that are included within the ETF. And then if you go even further, you can have a look at the top holdings. The top 10 holdings within this ETF are Apple, Microsoft, Amazon, the two different factors of Alphabet, Tesla, United Health Group, Johnson & Johnson, Taiwan Semiconductor, and Facebook. So all companies that you've probably heard of before and are included for obvious reasons. Now there are of course lots of different companies, there's lots of different pages here, but if you click through you can see that the percentage of funds decreases slowly as you go through. So at the very end, the very back end of those last few companies will be a very, very small amount of the overall portfolio. So basically by investing in this ETF, you're putting the lion's share of your capital into the top 100 companies within the global market. If you're comfortable with that, then excellent. But if not, it's something to consider when investing in this ETF. Of course, as I mentioned, the VWRL does also have a distribution or a dividend that is paid to you as income, and you can choose what you want to do with. You can either invest it or reinvest it back into the VWRL, which is of course advised at the beginning of your investing journey to help to continue to snowball that investment, thereby giving you more dividends in the future when you can reinvest more, and you kind of get the picture. Alternatively, you can withdraw that as income. So you could utilize that as dividend income, and you could use that to pay your bills, to pay your rent, or whatever you want to be doing, which is what people more commonly do towards the end of their investing journey. Personally, I continue to reinvest every single dividend that I'm paid, just to continue growing my investment portfolio and helping the compound interest to take effect. The VWRL pays a distribution or a dividend quarterly, so at the end of each quarter, and currently it's yielding around 2.12%. You can see over here the last dividends that have been paid. The last dividend that was paid was equivalent to 83 cents. So that's around 70-ish pence per unit of the fund, which is again a very nice influx of cash and capital into your portfolio. Now, of course, with Vanguard, there are costs and minimums to consider if you are brand new to the platform. When you're opening an ISA or a general investor account for the first time, you have to either invest £500 or commit to a direct debit of £100 for the first few months. Personally, the way I did this was I saved up £500 and invested in the LifeStrategy. But it's just something to bear in mind if you are new to the platform itself. Other ways that you can access the VWRL are through platforms like Trading 212 and Freetrade, of which I've got links down in the description below, which will give you a free share if you sign up and invest just £1 or £2 dependent on the platform that you're using. So you can access both of them on those platforms, which will actually reduce the ongoing charge over time. That's because while you'll still have to pay the ongoing charge fee of 0.22% no matter where you hold this ETF, you won't have to pay the 0.15% account fee that Vanguard charge if you invest on either Trading 212 or Freetrade. So those are slightly cheaper ways of doing this. The advantage though of investing in a product like the VWRL is you can literally just set and forget. You can set up a direct debit, keep it going in every single month into just one fund, and you can watch your capital grow over time. Yes, you will have to log back in every now and again to reinvest dividends, but that helps you to feel part of the process, and if you are new to investing, personally, that is invaluable. As I've said, I don't invest in the VWRL. I personally am more concerned about fees rather than ease, and if I can spend 15 minutes every few months or so to reallocate my portfolio and save myself a bit of capital over time, I'm more than happy to do that. But if you are brand new to investing, the VWRL is one of the best ETFs that you can invest in on the Vanguard platform. If you want to know a little bit more about my approach to investing and my 6-fund portfolio, you can check that out just here.